Verizon stock pays a 4.7% dividend yield. That's more than 3 times higher than the 10-year Treasury yield. And Verizon's dividend, it looks pretty darn safe. Management seems to think so as well. It just hiked its dividend for the 15th consecutive year. Now, it wasn't a big recent hike, but the continued trend is great to see for income investors. And there are many reasons to like Verizon stock. Warren Buffett, via Berkshire Hathaway, bought shares back in late 2020. And he wasn't just dipping his toes in the water, he bought roughly $8.6 billion worth, and that easily puts it in his top 10 publicly traded holdings. Now, even before Buffett made that move, Verizon has been consistently towards the top of my personal buy list. And to be honest, it was kind of cool to see Buffett's move. That's really a big stamp of approval. We have similar investment styles and also time frames. Although there are a few considerations that have still held me back when it comes to investing in Verizon. In this quick video, I'm going to share one small hesitation that I have and also one big hesitation that I have with potentially buying Verizon stock. And if you find any of this research useful or thought-provoking, I'd really appreciate it if you just tap that like button down below, as well as subscribe, because that really helps out my YouTube channel. It also motivates me to share more of my research and ideas. Based on Berkshire's 13F filings, we can see that Warren Buffett bought in at right around a cost basis per share of about $59.24. And as of recording this video, last Friday's close, Verizon stock traded at $54.23. That means that investors can buy in at more than an 8% discount to Buffett's buy price. You can get a better deal than one of the world's best investors. And of course, Warren Buffett has made plenty of bad investments over the years, but on average, he has a pretty damn good track record. Over the past year, Verizon stock has bounced around, but overall, it has trended down. All else equal, with the company and economy, a drop in price creates a better buying opportunity. And there's a good chance I'll pick up a few hundred shares here soon. But here's my first small hesitation. So disruption is everywhere, and by its very nature, it's really hard to predict, if not near impossible. We live in a very data-hungry world, and more devices are connecting to the Internet of Things, and this does bode well for the telecom companies like Verizon. Although, what changes might we see in the next 10 years or 20 years? And more importantly, who's going to own those new disruptive technologies? Already, we're seeing big strides in low Earth orbit, or LEO, satellites. That's largely thanks to Elon Musk's SpaceX and Starlink. And really, across the board, we're seeing a wide range of communication technologies emerge and improve. Although in the near term, I highly doubt LEOs and other recent innovations will put a dent in traditional telco sales, especially when it comes to very dense urban areas. Although long term, it's much harder to predict. Now, I do only have a hobbyist level understanding when it comes to some of that technology. For a unique comparison, about 10 years ago, or more than 10 years ago, most analysts and experts, they would have thought that there's low to no chance that a new car company could compete against big auto. There are huge barriers to entry, such as capital requirements, safety regulations, etc. But as we've seen, Tesla has proven a lot of naysayers wrong and is now worth more than most large automakers combined. To stay competitive, the traditional automakers had to leverage up aggressively. Their balance sheets are loaded with debt, and it's been this way for quite some time. Although that's a bit of a double-edged sword. Borrowing money has really helped them compete, but it's also limited their ability and some of their incentives to innovate. If you've invested heavily in certain factory equipment, you kind of need to use it long enough to hit a reasonable ROI. For another quick industry comparison, we're seeing a similar situation with renewables chipping away at big oil. It's a long transition, and there's still probably plenty of money to be made on fossil fuels, but debt-heavy oil companies, they're struggling to pivot. Across the entire oil industry, they've lost a lot of financial stability. So back to the telcos, Verizon, AT&T, and a few others, they've really built impressive moats. They're also in an industry with high barriers to entry, And this has required taking on a massive piles of debt to stay competitive. With the recent race to provide 5G, we've seen debt levels shoot even higher. Now, this trend really leads me to my biggest concern with investing in Verizon stock. In the past 3 years alone, Verizon's total debt has climbed from $113 billion to $179 billion. That's up close to 60%. Verizon's revenue, on the other hand, is up close to 0% over that same time frame. For investors, these aren't great trends to see, and they're likely big factors that have really helped push down Verizon's stock price. Although Verizon is still a huge cash flow machine, and it can easily make its debt payments, especially in our low interest rate world. Now, with the leftover cash flow, Verizon can also easily pay its dividends. Although if the trends I've shown you don't really change, the dividends are not going to look as safe in the years ahead. For a more direct comparison, AT&T is also highly leveraged. It's made some bad deals over the years, and investors have also beaten down its share price. I personally bought back in late 2018 when the dividend hit just over 7%. And to be honest, I got pretty lucky with the timing. I don't really try and time the markets. I had some nice unrealized capital gains for a while, but since it's dropped back down, and if you don't count the dividends, I'm roughly about break even. But of course, we need to count those dividends. Those put me right in line with average annual returns, close to the long-term stock market average. Although AT&T recently announced that it's going to be cutting its dividend next year. This is going to be the result of spinning off its media business, Warner Media, and merging it with Discovery in what's called a reverse Morris trust. It's supposed to be a more tax efficient process. For income investors, this really isn't great to see, but pending some unannounced deal details, I still like AT&T as an investment at its current price. I've highlighted AT&T as well because big telcos, their dividends, they don't look as safe, at least as they used to be. Verizon is clearly still in a better position, but that might change in the years ahead, especially given the trends that I've shown you. Nonetheless, given a more comprehensive kind of market overview, looking at the wide range of opportunities, average equity valuations, Verizon, it still looks like one of the best risk to reward income stocks around. If I end up buying shares, I'll go ahead and pin a comment down below letting you know my entry price. And if you want to see one of my more recent investments, check out this video on Alibaba stock. There's risk there, but overall I like the risk to reward. And once again, I'd really appreciate it if you just tap that like button down below as well as subscribe, because that really helps out my channel. Or if you didn't like this video, feel free to tap that thumbs down button. And if that's the case, just please let me know why down in the comments below. Either way, thanks for stopping by, and I'll see you all next time.